All right, let's move outside the U.S. because you've made your opinion very, very clear. Emerging markets, there's some positives there. You like
Yes.
some countries in the emerging markets, even though you're
Yes.
not fully invested.
But we also have a problem because whereas the US had a credit bubble, we had an investment bubble in emerging economies. And to put it very simply and simplify matters, the US economy is not highly cyclical for the simple reason that the US simplified doesn't produce anything. The production is outside the US in emerging economies, notably China. So the US consumes, China produces, and because China supplies the US, it has growing industrial production, and then it invests money in capital projects to boost the industrial production. And so the emerging economies are much more cyclical than the US. So when the US goes, actually the markets reacted rationally. In the expansion phase, 2001 to 2007, the foreign markets emerging outperforms the US. Since we went into recession, it's the US that outperforms emerging markets. The emerging markets have been totally decimated.
We were talking a little bit about emerging markets. Let's stay in emerging markets for a moment. As we were heading to break, we saw that China's economy grew 9% most recent quarter. It sounds great. It's the slowest pace in 5 years. So I guess the worry now for people is just how much of a deceleration are you going to have, even in some of the fastest growing economies, whether it's a China or in India?
Well, I think the Chinese learned one thing from the US is how to doctor economic statistics. I don't believe for 1 second that China grew at 9% in the last 3 months. There has been a huge deceleration of growth in China, where a lot of contracts have been already negated, where the housing market has been very weak, and where there have been a lot of factory closings, especially in the south. So I think that we have a very substantial deceleration in economic activity that would, in my opinion, if China grew at an annual rate of 5%, they'd be lucky.
How about India?
Same, very high deceleration in the growth rate. And other countries, Europe is in recession. A lot of emerging markets are already in recession. And I think the whole world is in recession, very clearly.
Which part of the world is going to fare best through a recession?
Well, as I said, because the US doesn't produce anything, they're less cyclical than others. And the others, they had these huge overinvestments that they will have to digest. And because of this very strong industrial production growth we had in China and in other Asian countries, their demand for commodities was rising very rapidly. In addition to that, as industrial production grew, they had large capital spending projects, which also created demand for commodities. And that is now all going away. So I think, in fact, the Middle East will suffer quite badly, oil-producing regions and also other resource producers. And we've seen that in the currencies of some of these countries. The currency of Brazil has tumbled. The currencies of Australia, New Zealand have tumbled, and so forth.
That's actually where I want to go next. Is the recent strength of the U.S. dollar more a sign of the weakness in other currencies than it is of what's happening in the U.S.?
Well, partly yes and partly no. You see what has happened in the U.S. Between 1999 to 2006, the U.S. current account deficit grew from 2% of GDP to 7% of GDP. In other words, we went from $150 billion deficit to around close to $800 billion deficit. This money flew into the world and created the so-called global excess liquidity. Now, because the trade deficit is contracting, a clear sign of a recession in the United States, and because the current account deficit is no longer growing, it creates a relative tightening of global liquidity, which is basically bad for asset markets, but US dollar supportive. And I have seen statistics according to which the US current account deficit next year could decline to, say, 3–4% of GDP. If that happened, we would have a tremendous shortage of dollars. And that would boost the US dollar further.
Wouldn't that in turn help the US stock market?
Well, could be, but don't misunderstand or don't overlook the fact that this the relative tightening of global liquidity is not particularly favorable for equities. In fact, it could be deflationary for a while.
I know you don't see much in commodities other than gold. You still like gold to some point, not perhaps as much as before, but gold you like.
Yes, for the longer term, but I'd like to point out something which is, if you look at the commodities complex, what has been slaughtered are the industrial commodities, whether it's zinc or nickel and so forth. And gold has held up relatively well. And gold has also held up relatively well compared to equities. And I could see a situation going forward for the next 3 to 6 months where some of the commodities, including the CRB, actually rebound, and where people sell gold and move some of the proceeds in other industrial commodities and in equities.
All right, let's talk about equities. What if I absolutely want to buy something in equities? I want to make some money on it. It's difficult, but give me a name or two.
Well, first of all, I would say you should also look at corporate bonds, because corporate bonds have been decimated, especially in emerging economies. And they have yields now of 13 to 15%. So in some cases, they may actually be more attractive than equities. Secondly, around the world, we have had stocks dropping, in some cases, 70, 80%. These are some good companies that will survive. I can give you examples in Singapore of stocks that are selling at a third of the net asset value. Now, okay, the net asset value may come down somewhat, but not by 70%.
All right, give me a name or two before we run out of time.
Well, first of all Singapore REITs, the REITs, are inexpensive. Thai Beverage is inexpensive. Metro Holdings is inexpensive. Highflux is inexpensive. Fraser and Eve is inexpensive. You have the whole market, actually. You should just buy the whole of Singapore. The banks are inexpensive. Or you take the other emerging markets around the world. Say the Turkish fund has been decimated. If you buy it, I suppose over the next 10 years, you're going to make money. And actually, whatever you buy over the next 10 years, I think you will make money. You may go down first, but if you have deep pockets, like Bloomberg employees have, you will do very well.
Well, that was an interesting one. I'm not sure how well we'll do, but I'm glad you think that we have deep pockets, all the employees here. Nothing domestically.
Well, I think also, you know, the U.S. statistically measured, we're at the same level than 10 years ago. The return over 10 years is zero. And statistically, it's very seldom that you don't make any money at all over a 10 years period. So I suppose in the next 10 years, you'll make something. I don't think the markets will go up and rally very substantially, certainly not in real terms. If they pump enough money into the economy, maybe we'll go and make a new high. But then inflation accelerates, and in real terms, the market goes down.
Marc Faber, we've got to end it there. Always a pleasure to have you on Bloomberg
My
TV.
pleasure.
Thanks so much.